More good news on the outlook for jobs, retail activity and our fiscal position, but still against the backdrop of global tensions and rising inflation. Our updated forecasts after the federal budget and the RBA policy statement. Despite the volatility in the markets driven by geopolitical tensions and supply bottlenecks, Australia's economic data continues to run ahead of RBA and consensus forecasts, with unemployment down to 4% and likely to be in the threes in a matter of months, and retail sales up another 1.8% in February, which is 9% higher than a year ago and 19% higher than at the start of 2020. Our economic outperformance through the pandemic era delivered a revenue windfall in the federal budget of around $120 billion, also helped by rising commodity prices. And while almost 30% of the windfall was spent via new policy commitments, the vast majority was banked, locking in our AAA credit rating. Our net debt to GDP ratio is now forecast to peak at only 33%. So, while not everyone was happy with where the spending was directed, it was modest in volume and had a mix of short-term measures to address rising living costs and the recent floods, and medium-term investments in infrastructure, defence and skills development. The demand side of our economy still looks very strong, but supply remains the challenge now and probably for some time, which is the same problem being seen all around the world. US CPI has hit 7.9%, and their core inflation rate is 6.4%. So the US Federal Reserve have started their tightening cycle with one rate hike already, and the next two hikes are now expected to be 0.5% each. So the consequences of the inflation and energy shock that the war in Ukraine has added to is more urgency for central banks to tackle inflation. And in the US, suddenly their yield curve is inverted, with short-term interest rates above the 10-year rate, which, as the chart shows, has proved to be a very reliable indicator of recessions over the last 50 years. Fortunately, in Australia, we are likely to have a more gradual increase in official interest rates and a more resilient economy somewhat insulated from global factors. And now the RBA have dropped the word patience from their monthly monetary policy statement, making June the most likely timing for the first rate hike in their sequence. The inflation outlook is one of the few certainties ahead. All inputs, including energy prices, industrial and precious metals, and agricultural commodity prices, are adding to upside pressures. So, while some of these price movements may be helpful to our export markets, they add to the need for the RBA to normalise policy settings, which should equate to 3 rate hikes this year and roughly another 3 next, or an official cash rate of around 1.5%. As we mentioned in last month's report, the Aussie dollar will be a good barometer for our progress on economic outperformance and jobs growth. So, the recent run-up to 76 cents appears to support this outlook, as well as the surge in commodity prices. And lastly, the announcement of a free trade agreement with India is great news for Australian exporters looking to diversify their markets and also to deal with a slightly firmer Aussie dollar. Exports will be sharply higher for services rather than just goods in the months ahead, so the more bilateral trade agreements the better in these unique economic conditions. And that's the market update from Bendigo Bank.